Welcome to PlotLines, where we'll use our over 30 years of experience in real estate communications to uncover the real stories behind real estate. I'm Heather Crowell.
And I'm Britni Acriveau. Dive in with us as we invite guests to break down the ever-changing landscapes of real estate together. Welcome back to PlotLines. We're joined today by Mike Lohmeier. Mike is the CIO of Impact Community Capital. Mike, thanks so much for joining us today.
Thank you for having me. It's a pleasure to be here, and I look forward to the conversation.
Us too. So why don't we just dive right in? Why don't you tell us a little bit about yourself, about Impact, and give us a little bit more on your background?
Excellent. Thank you. Impact's a really unique place. I'm happy to share more about it. Impact was originally founded and is currently owned by several large insurance companies, founded with the distinct purpose of making impact-related institutional quality investments. And we've developed over our 25-year history several really unique ways to do that. So we're primarily investors in debt in multifamily commercial real estate.
Okay.
We've also pioneered products, creating commercial mortgage-backed securities through our own shelf product, and then also working with the agency lenders, primarily Freddie Mac, on some of their negotiated transactions and securitized products. And so really exciting place to work. We do a lot of really innovative and unique things. Yeah. My background actually came from the other side of the business. I worked at an asset owner, previously a religious affiliated pension fund, where I managed the team who led the public and private market. So equity, private real estate, private equity, public fixed income, all of the products. It was a really exciting place. That firm as well was a pioneer when I started there, it was called Socially Responsible Investing. They were founding signatory to the Principles for Responsible Investment, the UNPRI as it's commonly known. So long history working in responsible investments, impact investments, as well as traditional capital markets. We're on the West Coast. Impact is in the San Francisco Bay Area. I'm a native Midwesterner. Lived most of my life in the Chicago area. And so if you hear a little Midwest twang, that's where it's coming from. But pleasure to be here. Thank you.
Yeah. No, thank you so much for joining us. We're looking forward to this conversation as well. So the whole purpose of our podcast is to break down headlines, current headlines, and determine, kind of their validity, what your thoughts are, and give us, ultimately a chance to kind of amplify or correct the narrative that's kind of prevailing. So some of the recent headlines that we are seeing, around the housing affordability crisis and just general multifamily demand are, the New York Times recently talked about how whether interest rate cuts would fix the global housing crisis. And we saw another article that the level of multifamily oversupply may be smaller than you think, which I think, also kind of talks to demand a little bit. So what are your thoughts on those headlines and kind of what's the reality out on the street?
I'd say, I agree with the premise of those headlines, but I'd say that I think there's more to it. I think actually, particularly relates to affordability in the multifamily space, it's been a much longer term crisis than something acute and occurring right now. But certainly some of the current demand issues, the excess demand in multifamily has been because of the affordability in the for sale market. Yeah. And interest rates tie into that, right? Mortgage rates go up. We all know that the pace of sales in the single family space has dwindled to almost nothing, even though price increases are really high. So the affordability in the for sale markets means we create more renters by not by choice, but by need. And while there's been a significant delivery of multifamily over the last few years, almost 500,000 units a year, there's been significant demand for that. And so in some markets, there has been some absorption issues, but for the most part, those units are getting absorbed. Yeah. I'd say it's not really a regional issue either. There are softness in markets where you see rents decline in places like San Francisco, where we're located, and you see strength in the Midwest and the Northeast, but the differences aren't too dramatic. I'd said in the kind of beginning that it's a longer term problem. It's not an acute crisis. It's more of a systematic crisis. And that's because our country hasn't developed enough affordable multifamily rental for decades. If you go back and look at supply coming online in the 1980s, just of any market rate and affordable, it was significantly higher than the 1990s or the early aughts. And only until the last few years did we see significant multifamily development. And what that's led to is that population growth, household growth has been significant. Our population is almost twice as high. We're at about 350 million. We're at about 200 million in the early 1980s. We just haven't built enough multifamily. And what that leads to is a lot of people are paying more than 30% of their income on rent. And that's where the crisis is most felt. People are, there's, in some markets, there's homeless issues, but most markets, people are just paying too much in rent.
Right.
And that's a real problem because it bleeds into other things, healthcare, education, childcare issues.
Yeah. So it's interesting when we were talking even before the show started recording, we talked a little bit about that imbalance, right? And how that actually creates a great opportunity for institutional investment. So talk to us a little bit about that imbalance and what that does mean for investors on the affordable housing side.
So, obviously if you have a product, an affordable rental unit, and it's sought after, right?
Yeah.
I always say it's like winning the lottery. If a tenant is able to find a unit that's affordable to them, they won the lottery. Because in some markets, they can save $1,000 a month on rent, or $800 or $1,500 depending on the market. And so it is. I mean, literally, it can be thousands of dollars. What that means is you're not going to do something that's going to mean you lose that. You're also going to stay there. So housing tenure is longer in affordable units, which means occupancies are higher.
Yeah.
When there is a vacancy, it's filled faster because you have significant number of tenants on your wait list. And that all means that the cash flows at that property are stable.
Yeah.
Now, there's a lot of research out there. Owning affordable housing from an equity perspective doesn't necessarily produce greater returns, which makes sense. You typically have, less, lower rents. You have lower cash flows compared to your operations. So it's stable, but it's not producing 30, 40% returns. Where you do see equity returns is if you're able to turn those units and potentially sell into environments where you have lower cap rates, right?
Right.
And so the appreciation adds some value, but on cash, it's fairly stable and usually lower than market rate. But from a debt perspective, as a debt investor, I don't really care about the upside. I like that stable cash flows because it means that the default risk on those investments is lower. Right. And there's a lot of research. Freddie Mac publishes a lot about their K-series program in multifamily and they're affordable. There's research from Cohen Resnick, which is an accounting firm on affordable, the low-income housing. The performance of these affordable multifamily, the default rates are far lower than anything else in commercial real estate.
Okay.
And that's what we think. And so if we're getting attractive returns for this product that's more stable and lower risk, we think that's a really interesting place to be for investors. Particularly since many of our investors are insurance companies who are already some of the most risk-averse investors.
Yeah.
Right?
So that's interesting. So I guess speaking to it from that investor perspective, maybe talk a little bit about investment in affordable multifamily relative to other asset classes, other housing asset classes, industrial, like where's the compelling investment or what makes it a more compelling investment to you relative to these other asset classes?
But I think it depends on where you're putting it in your portfolio. So if you're looking at things from a value add or opportunistic perspective in your real estate equity portfolio, you're probably not going to have a lot of multifamily rental. It generally, it doesn't perform that way. Now, I'll be honest, if 10 years ago in 2013 and 14, there are some funds out there who looked at it and did a lot of opportunistic investing in multifamily and did really, really well.
Right.
Okay.
That was a cyclical, there was a time point, there was an opportunity in the market. Long term, it really is, it's more of a core asset. Like I said, you have stable cash flows, it's lower risk. It really should be thought of as something core that you invest in all markets. We think it's compelling because we haven't gotten to the point where everybody considers it core, right?
Right.
So there are opportunities for cap rate compression into the future.
Yeah.
There's opportunities, we think, really to change the nature of the way it's developed. And so there's a lot going on in places, may surprise some of your listeners, like Texas. You wouldn't think of the most innovative, affordable housing state, but they do a lot with their property tax code to provide incentives for market rate developers to offer affordable housing in ways that are unique and innovative. Yeah. It's not just simply relying on government financing or subsidies to make it work. They're using the tax code and other things to encourage an institutional investment in
it's interesting.
It's really interesting.
That is interesting because you normally kind of hear about it as like an allocation of multifamily developments needs to be affordable. So I think, incentivizing that investment across the board is maybe a little bit more
and
helpful.
treating it on its own almost, it sounds like, as opposed to what Heather's suggesting as a part of the whole, right?
Well, I think what's interesting is that many will understand this. Like teachers and and nurses and people who are maybe making more moderate income, they typically aren't well served by affordable housing programs, like the apartments that are capital A restricted affordable housing. But they need what's called like workforce housing.
Yep.
Right.
And that's, maybe at 60 to 80 to 100% rent levels of the area median income, that target area. And you can do things with the tax code or with, light subsidy to try to drive that. And that's where the greatest need is.
Yeah.
It's interesting. We produce at 60%, we produce a lot of units that are affordable to people making 60% of their area median income. We don't produce a lot for people who are truly like very low income.
Yeah.
And we don't produce a lot for people who are moderate income, right? Who end up paying more than 50% of their income as well. So it's really about targeting the incentives. So we see a lot of opportunities.
Yeah. And Heather had mentioned some other asset classes. Mike, I want to circle back on that. Manufactured housing, we're hearing a lot about that. SFR, obviously build to rent, all these others, but even like commercial. I know you had mentioned sort of industrial when we first brought this opportunity to you. Tell us about sort of how they all stack up against each other.
So we really think, there are interesting opportunities. Single family for rent is really interesting in some markets. Obviously it's been built up a lot in Phoenix and Nevada and places like that. Because it serves a long-term need, right? And it also meets people where they're at. So a lot of people would love to have a single family home. They like the lifestyle.
Yeah, of course,
but they might not have the ability to have the tenure, right? Or the job security to support, ownership. And so being able to deliver those experiences is really interesting. And the manufactured housing, and the manufactured housing side, actually, I see those technologies bleeding into more traditional construction. There are firms who are using, we'll call it factory-made housing, factory-made tools to increase the pace of development and also to reduce the costs. So I think there's a blending of sectors or categories maybe over time a little bit. And on the industrial side, I think one of the things that we value, and we work with a lot of different lenders as well as operators, is development that's oriented towards community building. And so you can't have housing off by itself. You can't have retail.
Right.
That's the traditional, so we think of it as like the suburban model, right? Like with land use, everything's got its little sector. But thriving, communities have that all together. And so building industrial with housing and with commercial and retail near it, we think is part of a holistic approach. And so we see opportunities in that infill as being really supportive. Again, there's a famous book in the impact space called The Bottom of the Pyramid, which is this idea that, if you serve the bottom of the pyramid, that's actually the largest swath of people.
Right.
They have individually the lowest incomes, right? So they're, but developing, so in America, we typically don't think that way.
Right.
But developing real estate strategies that are focused on the communities, most in need actually produces some of the greatest returns because you build products and development that have the greatest use.
Well, that makes sense. It makes a lot of sense, actually. One of the things that we sort of hear about, this touches on multiple sectors here. So one of the things that you sort of read about, and it hasn't been implemented quite as much as maybe initially thought, is sort of the conversion of office buildings to multifamily, and whether or not an exploration of whether or not that could maybe solve some of the supply demand imbalance for housing needs. What are your thoughts on that? Have you seen anything? You mentioned you're out on the West Coast where some of this has been bantered about. What are your thoughts? Are you seeing anything work in that area?
We haven't done any reuse of traditional commercial yet. We have seen historically a lot of reuse of other types of buildings, schoolhouses, factories, light industry. What we have had conversations about it though, and I think the challenge is if you're looking at the typical, we'll call it like central business district office building, people think of it's 1980s, 1990s. It's more of a modern design, which is actually more of a challenge to redevelop into affordable from a physical structure perspective. You have big open floor plans where you don't have the ability to create units that have light and windows. It's the older buildings in cities like San Francisco or New York or Chicago. I mean, you've already seen it in places like New York and Chicago, right? You know, in lower Manhattan, they've had a long history of converting business office buildings into condos and multifamily.
Right.
Those buildings are older, so they have a design that makes itself more readily converted. I think the challenge is going to be just that of all the modern office buildings, which seem odd, right? Because they're newer.
Right.
You know, all the systems that would seem to be better, but they just don't have the features where people want to live. You know, people want light.
Right. You know? Right. They do.
You know, they don't want all one wall to be windows and then the rest of the apartment to be. And that's really the challenge, particularly in larger buildings. So I think it will happen. I think you'll see cities look to develop, as I mentioned earlier, communities that are more mixed. I think that's the lesson.
Sure.
Central business districts through COVID cleared out, and there was no activity there, and it's not coming back.
And still 5 years later, we're talking about it. So
it's the communities that are already moved towards a more holistic approach that had housing and retail and commercial and entertainment all in one place that seem to be thriving more.
Yeah. I actually heard recently someone talking about converting retail to multifamily. And that's a really interesting idea too, taking vacant department stores and things like that and converting them. So there's a lot to watch there, I think, over the next few years.
It's always fraught with challenges. Yeah. I mean,
no, go ahead.
It starts with design, right?
And the infrastructure. Very interesting. I want to shift a little bit to what you do at Impact Community Capital. And we know you have a really strong track record of community and social impact. So tell us a little bit more about that and how you sort of balance that and what strategies you use to deploy on that side of things.
Yeah, I mean, I think I alluded to earlier, one of our key features is looking at the social impact and the rent burden of our units. And so one of the key underwriting criteria we have is something we call the rent gap. It's the gap at a unit basis between market rents in that community and then the rents that will be charged. And so in a sense, that's the $1,000 a month when they win the lottery. But from an underwriting perspective, that tells you the competitiveness of that unit in the market. If it's got a $1,000 difference between market rents, it's very competitive. If it's $50, it's competitive, but not overly so, right? So that's a key measure from underwriting. We look at that as assessing that. I'll use an example. I lived in Illinois. Decatur, Illinois is a small town. It's actually where the Chicago Bears were originally from. Market rents are lower than affordable rents in places like Decatur, Illinois sometimes, which means there's no gap, which means that property is just competing in the open market. There's really not a need, as much of a need for affordable housing, right? There's a need for safe and sanitary and more modern and safe housing, but not affordable.
Right, but housing is generally affordable,
and so
it sounds like.
That's a great underwriting thing to know, right? I don't know if I'd invest in, no offense to Decatur, Illinois multifamily right now. New York is different. Philadelphia is different. So that's a key underwriting measure. And it's also our key impact measure. So when we look at our portfolio and we produce an impact report, and it's on our website, we look at that rent gap across units, across properties, across the portfolios, and we use that as a key measure of how much impact we're bringing to individual tenants' lives. And so impact is part of the investment, is the way we look at it. It's part of our investment philosophy too.
Yeah, that makes sense. If you kind of look ahead, what do you view as the biggest challenge to the affordable housing sector, right? And investment, like you said, if we can get investment in it and it becomes more mainstream or more of a core asset, then there's cap rate compression. But what do you view as kind of the biggest hurdle in getting there, in getting to investors considering it a core asset?
I think there's two elements, and I spoke about it a little bit earlier. One is expectations. Right?
Yeah. Okay.
Oh, it's affordable housing. Well, this should be, opportunistic. We should make outsized returns. It's more risky, so we should have higher levels of return. And that's really not the case.
Right.
And so overcoming that expectation, I think, is step one.
Yeah. Okay.
Because and we deal with that all the time on the debt side, but more so when we talk with equity investors, it's expectation. So understanding the space, understanding the risk return profile. Every investor has to make their own judgment about how that fits in their portfolio.
Yeah.
But we think it's compelling. So I think that's step one. Is there's myths, right?
Education.
Education. There's this myth that it must be riskier.
Right.
Right. And that's clearly not the case. And I'd say, secondly, some of it has to do then with producing more affordable housing as a society to provide greater investment opportunities. It's one thing to bring investors to the party. It's another to have enough punch to go around.
Yeah,
and if we're only doing 100,000 units a year, that's not a lot. When you start thinking about institutional investment, on the it's just a few billion a year in terms of the debt investment for low-income housing tax credit properties, for example. That's not sufficient to bring institutional investors to get them interested, right? Even if they wanted to, if they can't find investments, they're not going to stay.
Right.
So that's, I think, the two biggest parts: education, and then also developing enough property and enough investment opportunities for investors to stay.
Yeah. Okay.
Well, Mike, I think that leads well into our final question, which circles back to where we started with Heather asking you for your take on current headlines. So now we want to give you the opportunity to rewrite the headline for affordable multifamily. What would that look like if you could write your own?
So I'm not a copy editor.
That's okay.
By any means. So here's my best attempt to make it interesting as well, I guess. But, surprise improvements in affordable housing have unlikely caused, increasing institutional investment, something along those lines, where institutional investors recognize the space and then we're able to produce opportunities such that we can actually meaningfully address the crisis.
Right.
Because right now, that doesn't appear that any of the things that we're trying as a society from the impact side, are making a significant dent. And then on the institutional investment side, there's that education that needs to go on. We need to bring investors into the space. Recognizing, the investment for what it is, a lower risk, lower return, or asset.
Yeah. That's helpful.
Yeah, that is.
All right, Mike, is there anything else you think our listeners should know?
No, I would say thank you for your time. I really appreciate it. It's interesting as not being a writer or having a journalism background to think about the world through headlines and through our reaction and digging deep into them. So I appreciate the format and your time, and it was a really interesting discussion. Thank you.
Yeah, no, we appreciate your time. It was enlightening.
Thank you.
To say the least.
Thanks so much, Mike. Yeah. All right. Well, that was another really interesting conversation. Appreciate it, Mike's insights. Obviously, this affordable housing crisis has been a big topic of conversation, especially heading into November. So
and I think it's an interesting perspective when you think about like the kind of catch-22 that he described of like we want to make it more investable, but there's not enough investment to drive the investment. When there is investor interest, there's not enough units being built. So at some point that code will be cracked and hopefully there will be enough affordable housing for everyone.
Definitely. All right. Well, another great episode. Thanks for joining us, and we'll look forward to seeing you next time.
This podcast is a production of Gregory FCA. If you enjoyed our discussion, please subscribe wherever you listen to podcasts